So it seems some people are confused about how the cash value of life insurance policies works, right? So I kind of want to go over it, give some good information to maybe help you do a little bit better research, or maybe you didn't know that your insurance could have cash value built up in it that you can access. So, but let's start off with, what is the cash value of life insurance? Like, what does that even mean? Well, basically, cash value life insurance is a type of permanent life insurance, right? So it's going to combine two functions: a death benefit that provides your family with a payout when you're gone, and a savings or investment vehicle. Now, not every type of insurance has a cash value component, but some examples of ones that do, whole life, universal life, variable universal life, right? Cash value life insurance generally costs more than term life insurance, right? You're paying for longer lasting coverage and cash contributions that you can remove from the policy while you're still living. Now, high income earners often use permanent life insurance when putting together a complex end of life, financial strategy, right? Retirees who no longer, earn income may also find it useful. Adults with someone who will always be financially dependent on them, they could benefit greatly from this. Now, if you're worried about the ability to get insurance later on, this type of coverage, it could be a worthwhile option, right? So, what life insurance policies have cash value, right? It's all about the money. Well, there's three common types of permanent life insurance policies that have cash value. They're going to be whole, universal, and variable universal. But there's a bunch more. But each life insurance policy accumulates cash value in a different way. So let's start with whole life insurance. Whole life insurance is one of the most common cash value life insurance policies. In exchange for premium payments, you'll get a death benefit and cash value. The policy generally won't expire unless you stop paying premiums or surrender the policy. Payment options may range from single premium to limited payments to lifetime payments. A baseline interest rate keeps your cash value accumulating at a rate set by your insurer. Dividends may be available, but that's not guaranteed. Then we've got universal life insurance. Now, this provides a death benefit and cash value. Generally, the policy won't expire unless you don't provide enough funding for the contract to remain active. Compared to whole life insurance, universal policies offer more flexibility in premiums. You can speed up or slow down your payment amounts. You can also choose from a few options on when your payments will be due. But, expect to earn interest on that cash value, right? And it just generally keeps up with current market rates, so that's pretty good. One thing to note about slowing down premium payments, though, you're going to want to be mindful if you decide to slow it down. Because when you reduce premium payments, you may also decrease the cash value of your life insurance or decrease the death benefit available to your beneficiaries. Reducing premium payments can make it take longer to meet your life insurance policy goals. Make sure you're always talking with a financial advisor before you're altering, any plan contributions, right? So the third one was the universal, right? Variable universal. Now, this life insurance is one of the most feature rich permanent life insurance options. It provides a death benefit and cash value, and it also comes with investment options. This is combined with the flexibility of payment timing and frequency that comes with universal life. Variable universal life policies have investment subaccounts where you can invest the cash value of your policy. So, if the market performs poorly, there's a chance that a variable policy can lose all its value and terminate. There are also fees associated with portfolio management. Together, these things can or may impact how quickly your cash value builds up. Similar to universal life, you'll want to be mindful if you decide to slow down those contributions. When you reduce those payments, you can decrease the cash value of your life insurance or decrease the death benefit available to, your beneficiaries. So, how is that cash vendor, how's that value calculated? I mean, how much are you going to get if the cash surrender, you go forward with it? Well, it's pretty straightforward. It's determined by the amounts of premiums paid, the length of time the policy has been in force, and the size of your death benefit. The exact cash surrender value calculation will depend on the insurer you choose. In some cases, you can customize the balance between cash accumulation and death benefit as you open the policy. Keep in mind, when you pay an insurance premium, the money goes to three places: the death benefit, the cash value, and the insurer's cost of doing business. Okay, well, why would you even want to access the cash value, right? Like, what reason would you have? I mean, people generally remove money from the cash value when they need the money, and it can be tax free, right? And there can be a couple of reasons, but we'll talk about some of the bigger ones, right? But they do this through a cash value surrender or a loan. The cash value can help fund major expenses, right? So think of putting your kids through college, living in retirement. Maybe you want to buy a new house, or maybe worst case scenario, right? You use it as an emergency fund. Yeah. So how does accessing cash value from a life, insurance work? Like, where do you start? Well, when you access the cash value of your life insurance contract, you'll reduce your death benefit. You also may have to pay fees or taxes in some cases. Above all, life insurance is for providing your loved ones with a death benefit when you die. Usually, you have to wait at least a few years before accessing the cash value of your contract. Taking a loan or withdrawal once it's available will decrease your death benefit. If you withdraw too much, your contract could also terminate. So, there are a couple of things to keep in mind before taking money out, right? Now, make sure you always talk with your tax advisor and your financial advisor, though, to learn about some of those implications, right? If your life insurance is considered a modified endowment contract, you know, different rules might apply to you, right? There's just so much stuff going on. So, what are your options when you want to go access it, right? Like, what do you get to do? What can you do? What can't you do? Because there's multiple options for accessing that cash value, right? Withdrawals, loans, full surrenders, right? And it's worth repeating that you'll probably have to wait at least a few years after opening a policy to access the cash value that may have become available. If you access your cash value sooner, your life insurance may lapse. The funding needed to keep a contract active may change after removing cash value. So, we've got withdrawals of cash value, right? Many policies allow you to take a tax free withdrawal up to what's known as your basis or cost basis. The basis is the total of all premiums you have paid minus any previous withdrawals and dividends received. You already paid income tax on your money, so you're not going to be taxed again. However, your death benefit may be permanently reduced by the amount of your withdrawal. So let's do an example. Person bought a whole life insurance policy when they were 32, right? Person had their first child and was in a high tax bracket. So she liked the idea of using a cash value policy to continue protecting her assets. She already had a lot of them. Every month she paid her premium. But today, she's 58. Her home is now paid for and she is no longer financially responsible for her children. Her financial strategy has changed, so she wants to lower her death benefit. Her financial advisor helps her do this. Together, they withdraw money from the policy, which lowers her death benefit. As a result, Robin has withdrawn part of her policy's cash value to use somewhere else. At tax time, she's going to pay income tax on any cash accumulation greater than the sum of premiums she's paid through the years. Now, note that the withdrawal she made has now reduced the cash value of her life insurance. Restoring value to the previous amount may not be allowed within the terms of her policy. And because of this, it's important that she fully considers future needs when deciding between withdrawals and loans. Right? Speaking of, let's talk about taking a loan from that cash value. Because when you take a loan, right, you're taking cash value from your contract and reducing your net death benefit. You're expected to repay that loaned money with interest. Once it's repaid, your death benefit and cash value will be restored. Loans are generally income tax free, right? But let's say disaster strikes and you die while the cash value from your policy is still on loan, or maybe you decide that you don't want to pay it back. Loans will reduce the amount paid to your beneficiary when you die. Well, how much can you borrow then, right? Well, the amount you can borrow from a life insurance policy is determined by the type of policy you have and its current cash value. How much you've paid in premiums can also impact how much is available to borrow. The consequences of borrowing may also be tied to how much you've paid in. Once a life insurance policy, allows borrowing, you can often borrow tax-free up to what's known as the basis in the contract. Now, the basis is the total of all the premiums you have paid minus any previous withdrawals and dividends received. Anything borrowed beyond that amount will require an income tax payment. Think of this last piece as new income that you haven't paid taxes on before. Now, if you withdraw all or nearly all of your money from your life insurance policy, it's likely going to terminate. It's important to monitor your contract and ensure your funding is sufficient if you want to keep the life insurance active. What are the tax, advantages then? Like what's good about it? Well, cash value in life insurance has got about three really big main income tax advantages, right? Usually tax free, right? The death benefits, don't gotta worry about paying that. Tax deferred cash accumulation, yeah, we really like that. And usually income tax free withdrawals and surrenders, fantastic. In some cases, adding a large lump sum to your life insurance policy can result in the IRS reclassifying it as a modified endowment contract. These contracts have different tax time rules than standard life insurances, right? But some of the advantages. Let's just talk about a couple. You have the death benefits, right? That generally, income tax free, tax deferred cash accumulation, and the withdrawals, right? And let's talk about the withdrawals because they have kind of a caveat, right? Withdrawals and surrenders that are usually income tax free. So if you no longer need your death benefit coverage in full or part, you may also be able to access the cash value of your contract to cover other financial needs. Although withdrawals are usually income tax free, there are special cases where withdrawals and surrenders can generate an income tax liability. For example, a significant taxable event can occur if a contract terminates with outstanding debt. You know, Again, make sure you're talking to like your tax advisor, financial advisor, right? Get those details before you make any big decision. Make sure, I'm going to repeat this, make sure you do enough research to understand what your needs are. I'm sure you've seen a bunch of people talking about they get these whole life policies and they build up cash value and they're taking the money out to buy a house or start a business or do, and it's everywhere. But I want you guys to have the information you need to make a good decision, right? So I hope you guys enjoyed this video and got some good information on it. If you did, smash that like button. If you're not subscribed to the channel, I'd appreciate it if you did. But until I see you guys in the next one, y'all be safe.